Ladies and gentlemen, welcome to part 3 of TMO Trading Steps. This is your man Z Moose coming at you from the Moose Den, as always. Tonight we're going to be discussing measuring maximum risk, maximum reward. We're going to do a little bit of a basic overview of hedging. Now I know that in part 2 we touched upon measuring risk and reward. And as you can see from the first bullet, it is extremely important to measure your risk and make sure the trade you are about to make is even worth it. I have run into this mistake. I've seen other people run into the mistake where they may get caught in a trade and they think at that moment it's a good idea, but that's because they didn't measure their risk-reward setup. And when they finally, after entering it, then they start doing their work on the risk-reward, and that's when they notice, wow, the trade that I just took is not going to make me a dime. It won't make me a nickel. It may not even make me a penny. And the worst case scenario is that it actually loses you money, and there's no way that you can possibly make any money. That's tough. That's difficult. And I've gotten myself into that situation where I got so rushed into a position and then realized, wow, that was a terrible trade. Properly analyzing your maximum risk reward and your maximum risk and your maximum reward is almost as important as measuring the risk reward defined within the parameters you designated for a trade. What do I mean by that? Let's take a look at the parameters that we would set in Occidental Petroleum, ticker symbol OXY. And we're going to use this as our example tonight because I was looking at the Apple chart and it broke out pretty big. I was expecting a pullback. Well, I was hoping a pullback. I wasn't really expecting a pullback, but I was hoping for a pullback and never got it. So, Occidental Petroleum right now is kind of in a neutral range in between 88, 90, and 85. I'm sorry, 88, 80, and 95, or 85. So, when you're looking at this trade, you think, alright, this might be a good idea, let it consolidate for a couple days and then get in it when volume starts to pick back up. So, before we even start taking a look at things, let's take one single naked option, call option, July 85 calls. Let's do that. Let's add it at 375, and we have this transaction here. Our profit target is at 880, as you can see, and our profit loss, or I guess our loss target, not our profit loss, our loss target would be at 84. It would be a buck below the support level. If you look at this trade, you can see that the risk reward is not there. Our potential for loss is much greater than our potential for gain. And even if we were to kick it at 85, the only difference between the profit target and our loss target would be $5. That's not a good trade. It's not worth it. So if we look and we start taking a look at the chart again, if we do consolidate, not only could we have the potential to just sort of roll over a little bit here and touch along that support line, but do you really think that we could go higher after this low volume run higher? Chances are that you're not going to go much higher in this stock. So to take this trade just like this is not worth it. Your probability of touching, if we check that out, there's a 72% chance that 84 could touch, and there is an 81% chance that 88.80 could touch. But when you look at the technicals don't really support the cause. It's a little overrun. We're above all the major simple moving averages. And if we take a look at one of my favorite technical indicators, which I created, which I'll discuss in part 4, it's a little overrun here. The momentum's not there, and we might just taper off and touch support before we go higher. So this trade at this moment, not worth it one bit. So what do we do in situations like this? Well, if we go back to the slide here, knowing your maximum risk and maximum reward will allow you to better comprehend how much money you really have in the line. With that example, it really does kind of bring it into perspective. Wow, if that's my max risk, and oil starts to give up, its gains that it's made over the past 2 weeks, that's a little sketchy. You're looking at a trade that is just not worth it. But if we start looking into a basic overview of hedging, If you feel as if you are taking too much risk in a trade, but think that that trade will work out to your advantage. So let's say you really have a strong inkling that oil will continue higher. It pulled back 2 days in a row, Thursday and Friday, which is true, it did, in the August contract of crude oil. And, we touched along that 77.80 price support in the actual August contract of crude. So you think that that little rollover consolidation will just allow the stock in the next 27 days to skyrocket higher, we'll touch 88.80, and we'll be able to take profits away. But you can hedge this risky position with a position that counters the potential losses you will take if your main trade, in this case it would be Occidental Petroleum, goes south. It's not necessary to always hedge your positions, but if the market is sideways and you feel as though it may stay like this for a while, like we have in Occidental Petroleum, it may be a good idea to protect your long position or your short position with a hedge in the opposite direction. This is a smart strategy that a lot of people have begun to harness, and they are using it to their advantage. So what better hedge to do than the good old XLE, Spider Sector, Energy Sector Spider, ETF. As you can see, we are overrunning this as well. We're kind of setting up here in between 55 and 56. But why not hedge our position, and if Occidental Petroleum goes higher and it hits 88.80, we'll be able to take profit away. So let's analyze the risk reward of XLE. Let's say we buy 2 contracts to get to the same price as the Occidental contract that we bought. We buy 2 contracts of July 56 puts. Okay, so they are in the money, as you can see. We're buying July 56 puts, and if our price target is 54, okay, if oil were to roll over and XLE would drop to 54, and our stop target or our loss target would be at 56.25, we have a very good risk reward here that we could take. That's a very smart hedge to take. So let's say that Occidental Petroleum goes higher, it hits its profit target, and we make $120.31 on the contract we bought. XLE gets stopped out at 56.25. We take $64.15 loss, which means that on our trade through hedging, we make a $56.16 profit. Not bad. Let's say it goes the other way. Let's say oil drops, and we see XLE go to 54, and we see Occidental Petroleum go to 84. Okay? We're losing money on our Occidental Petroleum position. We lose $163, and with our Energy Spider Sector position, XLE, we make $201.20. Tough for me to get out. So let's take that. We take our profit, we subtract it from our loss, and we still make money off of the transaction. When oil drops, we make $38.19. When oil goes higher, we make $56.16. It is less, but this allows us to make profit both ways through our basic knowledge of hedging our bets. Ladies and gentlemen, that is part 3. Stay tuned to part 4. Enjoy your evening.